Hey, welcome back. Good morning, options traders. And it's that time again for more idiotic ideas. This one is number 4, and it is the secret of option writing. Now, for those who may have missed some of the previous episodes of this, they were inspired from a book. I'm not going to name the title or the author, but it's from somebody who claims to be a professional, ran a newsletter for years and years, possibly decades. But my point is to show why you have to be so careful where you get your information from. This is somebody who should know better, and yet you're going to see just how bad this information is. So this is the secret of option writing. What could it be, and is it really a big secret? Well, let's go find out. And as always, before we do, please be sure to click like and subscribe. It's always appreciated and helps so much to promote the channel. So, ready for the secret? Here it is. This is a direct quote from the book, and he says, the secret advantage of option writing is that you can enter trades where you have a very high probability of winning no matter what the market does. In fact, you can sometimes enter a trade that has a 99% chance of winning. In a sense, at times, they are giving money away on the exchanges. All right, well, this is just filled with so many fallacies, and yet people believe it. The first thing there in red, no matter what the market does, that is simply not true. It is possible to develop strategies that will win if the market goes up, down, or sideways in a narrow range, but not no matter what the market does. That would be too good to be true. And I've talked about this percentage myth before. It doesn't matter how high the probability is of winning, it gets factored into the prices. So this is just filled with all kinds of myths. It's just an incredibly bad idea. So the implication, obviously, is that what you could do here is sell hundreds of puts, which is probably what he's talking about. He might be talking about calls. But generally, when traders are talking about selling options as the magic strategy for making all kinds of free money, they're talking about puts. So that's kind of what he's implying, is that you could just do this over and over and collect all of this free money. Remember, it's as if the exchanges are giving away money. And yeah, once in a while you might have a couple that lose and you'll lose a couple of bucks. That's what it sounds like he's saying. But the reality is, if you do this long enough, that you're going to get hit with significant losses at some time. So it's a misperception. You have to understand that the probabilities of winning might be in your favor. No argument. But winning is different from profit. That's part of the misperception there. Just because somebody says, oh, I've won, I've had no losers on a bunch of trades, doesn't necessarily mean that they were profitable. So favorable profitabilities don't mean that you'll have gains. Why? We've talked about this over and over. Price is the equalizer. If there's a benefit in a particular strategy, the market will recognize it and push that price higher until that benefit is gone. So let's have a little deeper dive by taking a look at the Black-Scholes model, which does show probabilities, but it also shows the price. And let's see how those two are correlated. Now, another thing to remember is that options can't price what are called black swan events. We can't price in a huge earthquake or 911 or COVID, things like this that could really potentially disrupt a market. So we have to just talk about the volatility of the stock. That's really all that the Black-Scholes model is pricing. So let's go take a look at an Excel spreadsheet at a Black-Scholes model and see the difference between the probability and the prices. Okay, so now we're into a Black-Scholes pricing model. This is really done by hand, one that I did in Excel. But here we're looking at a stock price of 100, strike price of 135. So this is 35 points out of the money for the call options. Volatility of 60%, interest rates of 0, dividend of 0, and 90 days until expiration. So take a look if we have the stock price at 100. Now remember, we're pricing the 135 strike. So if you look over here, there is a figure right there that is called ND2. I'm not going to go into the definitions and the mechanics of it, but that is basically the probability that that option will go in the money. The reason I say basically is that this is under what's called risk neutral valuation, and we know that stocks don't follow risk neutral pricing. They're priced at something greater than the risk-free rate. So that's actually going to be a little bit low. But under risk neutral pricing, it'd be a little over 12% chance for that option to go in the money. But there's also a chance that it will, because there's 90 days until expiration and 60% volatility. And because of that, there is a price that is the fair value. And it's right there, is 282. So if you were to pay 282 for these options, let's say hundreds of times, you would be expected to just break even. If you sold it hundreds of times, you would be expected to just break even. What about the buy side? What if we wanted to push the probabilities really, really high? So we have this super high probability of winning, so to speak. Well, we could come down here and let's push these up really close to, well, let's see if we can get close to 100. Right there, almost a 99% chance that that option's going to be in the money. That's with the stock at 278. Now remember, this is the 135 call, so it's 143 points in the money. What a big benefit, right? Well, how much do you have to pay for this option? Right there, 143.14. You're paying 14 cents over parity for that option. You are paying 100% of the value of that advantage. So is it an advantage? Well, not when it's priced at 143.14. Priced at 14 cents over parity, even though you have virtually 100% chance that that option will be in the money. So this just clearly shows, yes, you can always find a high probability for a trade, but it's going to get priced in there. Now, if you want to go to the other extreme and say, I want a really low probability for this option to go in the money. So if you wanted to have a very low probability for the call to go in the money, maybe to sell calls, look, here's about a 6% chance, 6.5% chance that that call is going to get in the money. But you're also not going to receive much for it. Now, it might look like a lot, $1.30, but remember, there's 90 days till expiration at 60% volatility. This thing could go against you massively, even though you're going to make $1.30. So yes, it looks like it's free money, but once you consider the probabilities, it's priced exactly where it should be. It's not a great deal, it's not a bad deal, it's just fairly priced. So to think that you've got some kind of a big advantage by selling options is a complete misperception. So always remember this concept of fair value. That's what an option is priced according to a pricing model, and theoretically the way that the market is pricing it. It's based on everybody's perceptions of future volatility. So if we have the fair value at a certain level and it's priced too high, what happens? Yes, sellers will come in, and what does that do? It puts selling pressure on, price comes down. If they continue to think that it's too high relative to fair value, sellers jump in and equalize the price. They start bringing it more in line with where it should be. But what happens if too many sellers jump on? Well, yes, you can get to a point where it's going to be too low, and now the buyers are going to step in, and they're going to push it back up. And so this is going to go back and forth until you're just about priced where the option should be. So this is why you shouldn't just say, just because you're the option seller, you've got some kind of a huge advantage. It is simply not understanding how markets work. Okay, so let's dive in a little deeper by looking at the probability to win something versus the odds and the price to win. So if you have a 20% chance to win something, if it's a bet, we would say that the odds are 1 to 4 against you. You would have to bet 1 to make 4. On the other hand, if it's a game where you have to pay for it, such as like the options market, you would have to pay 20 cents to win $1. In both of those cases, whether you're paying 1 to make 4 or 20 cents to make $1, it's priced at fair value. What if the probability of winning is 30%? Do you have an edge? Well, the betting market recognizes that the odds are 3 to 7 against you. You would have to bet $3 to win 7, or if it's a type of a game where you have to actually physically pay for it, you would have to bet 30 cents to win $1. At 40% chance of winning, odds are now 2 to 3. You would have to pay 2 to win 3 or 40 cents to win a buck. At 50% chance of winning, the odds are 1 to 1. Got to pay a buck to win a buck or pay 50 cents to win a dollar. At 60% probability, odds are now 3 to 2 in your favor. You now have to pay 3 to make 2. Do you see what's happening? As those probabilities become more and more in your favor, the odds are going to flip. You're now having to pay a lot more to win less. Or you could pay 60 cents to win a dollar. At a 70% chance of winning, odds are 7 to 3 in your favor. In a betting type of a market, you would have to bet 7 to win 3. Or in a market where you have to physically buy it, you're going to pay 70 cents to win a buck. At 80% chance, they're 4 to 1 in your favor. Now you have to bet $4 to win a dollar or pay 80 cents to win a buck. And at 90% chance of winning, wow, it sounds like everything's super great. Everything's in your favor. Well, not so fast. Now you have to bet 9 to win a dollar. Or in a market where you have to buy it, you would have to pay 90 cents to potentially win $1. So again, it's just showing that no matter what the probabilities are, the market recognizes those probabilities and those odds, and they price it according to those probabilities. So let's look at it graphically. If you have a 20% chance to win, if we simulate this for 2,000 tries, look what happens. If it's priced fairly, you just go sideways. Sure, you can have pockets, little moments of brilliance when you end up on the winning side or on the losing side, but over time, you're just going sideways. Well, what about the seller? Well, the seller's just on the opposite side of the trade, so the seller's going to look like this. It's exactly the mirror image, just sideways. No advantage in being the seller. What if you have a 30% chance to win? Again, just going sideways. What if you're the seller of this bet? Looks exactly the same, it's just the mirror image. What if you find a strategy that has a 40% chance to win? If you're the buyer, if it's priced at 40 cents, you are going to go sideways. If you are the seller, you're just going to go sideways. 50% chance of winning, you're going sideways. The seller is going to look exactly the same, just going sideways. See, there's no advantage in being the seller because on average, markets are going to be priced fairly. So this is what your graph would look like if buyers are truly clueless, which is kind of what he's implying. The buyers would always be on the losing side. They're always taking these massive losses, let's say 99% of the time, which is why he's saying that 99% of the time the sellers are winning. But now think about it. If the buyers don't know the probabilities, they will always end up on the losing side. But that means they're going to wash out of the market. There's only so long that you can continue taking losses until you're washed out. And what that means is that the only traders that are left are the well-informed traders. And that means they will know the probabilities just like this guy does and just like everybody else does. In other words, there's no advantage in being the seller. So in his example, if you've got a 99% chance of winning, that's saying, let's say out of 100 numbers, maybe you've got to pick one and you're only going to lose if you draw the number 100. All right, well, that sounds like a great deal, but the market recognizes this is a highly favorable bet. The odds are 99 to 1 in your favor, or what are called 99 to 1 on, again meaning in your favor, and that means you're going to have to pay 99 to make a buck, or if you want to be the seller, you're going to receive $1 and possibly lose 99. So you're not going to make money no matter what the market does. You're just on the opposite side of the trade. So to answer the question, do sellers have an edge? Well, option sellers can't have the edge in the long run. Sure, at moments it can be the advantageous side, but so can the buy side. But sellers cannot have the edge consistently over time. If sellers do have an unfair advantage, well, nobody would buy. And if everyone knows the probabilities, no one will take the disadvantageous side. And so that means that that price will get sold down until it's no longer advantageous. On the other hand, if nobody knows the probabilities, then how can someone say there's a huge edge slanted in your favor? It's obviously just a really idiotic idea. And so, for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.